Hmm. Goes far. Yeah. Black and white. It's a good point. And also you got to be willing to focus on process too, in my opinion. Totally. Yeah, and like it's the stuff like this. Like I always take note of like who actually comes to things because I would do this lesson and record it for you guys and just like upload it with nobody here, right? Just because I'm gonna do it anyways. I'm gonna journal these things. I'm gonna keep doing like the process, right? Every day. That's how I operate. But it's seeing you guys show up, even like the few of you who I see every single lesson, and some of you guys who I work with, like it really does make me realize that like there's some people, right, and some people understand just like it's about the process. You can't kind of cheat yourself out of these things, and watching a video later or something that you probably won't do to the same extent and buy-in that you will attending the lesson. So yeah, I just want to let you know, like I noticed that stuff, and even if profitability isn't hitting you like on day one or week one, month one, it's like literally doing this time after time, week after week, that will eventually result in like profitability. Trust me, like eventually the hard work catches up. Like it's impossible to keep working this hard, PMA, and not be getting like seeing the results eventually. It just takes time, right? And it's not like you can see when you're gonna reach the end of that path. It's like you're just working and you're working and you're struggling and you're hitting and you're hitting, and then eventually one day it just like all connects, and then it's just like exponential growth from there, right? So yeah, I'm really happy you guys showed up. Yeah, but luck never lasts, right? Hard work and learning the skill and discipline and building the habits really are what last. Everything else is just, there's flukes, and of course there's flukes. That's how everyone starts off in trading, is usually with a fluke that gives them that euphoric high, and then they're chasing that forever, and they're not realizing that the hard work and the discipline, right, is really the magic. That's where the process kind of beats everything, and you start getting just incredible results and consistent results over a larger period of time when you have that. Okay. Yeah. 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 It's real. Mm-hmm. Mm-hmm. Yeah, because you're always comparing to a big picture. Yeah, totally. Yeah, but you're not realizing that winning in this market, which is so manipulated, controlled, and really stacked against you, is something phenomenal. And people also don't ever correlate, right, proportional gains with their account sizes. Yeah, $50 doesn't seem like a lot, but on a 500 or a 2,000 or a 2,500 drawdown account, $50 is fantastic. I mean, it's not about how much you can over leverage. It's about like trading is a game, is a system, right, of leverage. So it's not about over leveraging and trying to get 100, a 200, 1,000% returns on your $2,500 drawdown account. No, it's about building the amount of capital you can leverage and then risking 1% again, right? So those small wins, always like when you get a win and you say you won $50 in the day, take that number and divide it by your drawdown, right? You grew your account by 2% like in a day. Like that's fantastic. Some hedge funds get less than 1% a month, and those are the largest hedge funds that manage the most capital in the world, right? And they aim for 1 to 2% a month. So, that was hell yeah. All right, that was a nice aside. I'm trying to make this a bit shorter today, just to the point. Let's do a quick market review of what we saw today, and then we can do some questions, and then I'm gonna hop off and grab some Chinese food with my girlfriend. So I'm gonna start on a blank chart for you guys. Often I find that when I'm posting levels and signals, and not signals, like kind of my TA, there'll be a lot of lipstick on the charts, and it's really easy to say a lot of this is like hindsight, and it's hard to actually spot this stuff if it's already kind of on the chart. And I understand that. So what I'm going to work from kind of moving forward is a blank chart, and I'll kind of fill in these levels for you in real time as fast as I can, so that this picture here can be recreated, stepwise or piecewise over here. So as you know, today we're moving into Friday. There's always going to be the expectation of TGIF. TGIF essentially is the culmination of a weekly profile. If you've studied market profiling series, I'll have a lesson on that in the future. And essentially, it says that when you reach into your draw on liquidity or a higher time frame PD array, 4-hour to daily PD array, and the Friday puts in the low or the high of an expansion week, or right, the Friday reaches a key level which it was kind of programmed to do, i.e. the draw on liquidity, you can expect some form of meaningful retracement. Now, on a week like this week, right, we actually had a meaningful level taken out in this high. So the weekly profile, if you guys look at my last lesson and all of my stuff, charts and channels and everything that I post for you guys, was moving from this low down here, which is considered external range liquidity. So I can write this up for you guys. Oh, was my screen not sharing? Oh, I'm so sorry, guys. I've been talking on nothing. Thank you so much for telling me, guys. UPMA? Thank you so much. Okay, so like I said, I'm going to try and make this chart with levels make more sense, and I'm going to try and translate that to you and how I kind of synthesize my thoughts on this chart that's blank to get those levels. So as I'm saying, Friday, there's an expectation that if we had reached into the weekly draw on liquidity, or in this case, we're going to get that from the daily chart, that there will be a meaningful level of retracement back into a 20 to 30% of the range. Now, that's something that's done under market profiling guides and taught by ICT, but it's also just a reasonable expectation if you understand how the market books liquidity and how the market moves from what I teach you guys as IRL and ERL to ERL and IRL, right? So ERL is this low down here, this swing low, and we also have a form of IRL, which is going to be a fair value gap. So these are my two key levels from last week, which we traded into. Now, this daily fair value gap that you see here, which I'll mark out as a daily buy side imbalance, sell side inefficiency, and this swing low here is considered two forms of liquidity, ERL, IRL. Now, once the market reprices ERL, in this case, it will seek internal range liquidity. And once it prices IRL, it will seek external range liquidity. If we consider a chart like this, you can see that this is kind of how the market books essentially, right? Here we've taken out a high, that's external range. Then we come back into an inefficiency, that's internal range. So in your head, you can repeat the statement, liquidity to imbalance, imbalance to liquidity, liquidity to imbalance down here, imbalance back up to liquidity up here, liquidity to imbalance down here, imbalance to liquidity up here, liquidity back to imbalance, this one and this one, all the way down to this one. Now this imbalance and this liquidity is going to lead us to a weekly profile expectation to reach higher. And then the question becomes, how much higher? And what I like to use is something called a 20-day look back. So the institutional price delivery algorithm, IPDA is what I sometimes acronym it as, is going to look back 20 days to establish a short-term premium and discount. And when I say short term, I mean looking at the daily chart, for example. That would be considered a short term for this institutional delivery algorithm, which only trades and only really considers these higher time frame charts. So let's look at a 20-day look back. This is our 20-day look back. This is our 40-day look back. And this is our 60-day look back. So each of these levels are going to represent this halfway point, right? The shading difference is this halfway point, a discount and premium. Now, for this analysis on the weekly pull draw higher, what I'm going to use, right, is let me hide all this stuff again. I'm going to use this high right here as my 40-day look back, and it's very close to my 20-day look back, which is right here. And it's a noticeable swing high on the chart. And I'm going to take that Fibonacci and draw down to my low to determine what my dealing range is, right? So a dealing range is going to be notable swing highs that can be found by looking at pivot points in the market. A pivot point looks like this. A pivot point is an area that has taken out liquidity on both sides. So this is a high of the dealing range, and this is a low of the dealing range, these equal lows down here, because this has taken out this liquidity and this has taken out this liquidity. Inside of this dealing range is what we know as internal market structure. Now, internal market structure is defined by the extremity or these swing points. So there will also be relative discount and premium, especially on lower time frames, within this internal market structure. However, right, for the purpose of looking at this chart, if I was to tell you to consider this as the 1-minute chart, we would use these 2 points as our dealing range. And this is what the institutional price delivery algorithm, IPDA, is going to refer back to for levels of premium and discount. So let's consider the external range, or in this case, the dealing range is what I call it. As you can see, all week we've pushed up from this external range liquidity and internal range, daily fair value gap, into premium levels. We've repriced this inefficiency here, which is a daily sell-side imbalance, buy-side inefficiency, SIBI. We've also repriced this SIBI above. And finally, we tapped in to what was once a breakaway gap. Now, this breakaway gap up here, if you went to my last lecture, was expected to be a breakaway gap because we had something known as a redistributed, rebalanced PD array within here. So let me get rid of this. A redistributed, rebalanced PD array, I'm not going to explain it again, but it has a signature of this 2-candle pattern where we deliver sell side inefficiently and then buy side inefficiently, which looks like a long wick, followed by an immediate distribution to the sell side in the case of a bearish redistributed rebalanced PD array. This is called down, up, down, and you'll also see a similar signature for the bullish case where it looks something like this, up, down, up, and below this you'll notice we have a breakaway gap. So right on the buy side of the curve, and you guys would know what the buy and sell side of the curves are obviously if you have come to any of my lectures. So as you can see, we don't trade into this gap here because this piece of price here, right, supports this last push up, which is right here. And then once we've taken out this swing high, this is the liquidity, we come back in and we retest this redistributed rebalanced PD array, RDB is what I call it, and then eventually we break lower, and then you notice, look at the bodies, the algorithm will refer specifically back to this PD array, right? And the bodies will reject it. And this is what I teach about PD arrays being inverted on the opposing side of the curve, right? This is a very clear buy side of the curve, which you can see. And then this is a very clear sell side of the curve, right? And these two sides of the curve will offer very telling PD arrays on either side. As you can see, for an example, on the buy side of the curve, we have down close candles supporting price. So this down close candle supports price higher. Let me make this black. Right. And then we have this down close candle supporting price higher. These are known as order blocks or propulsion blocks, whatever you want to call them. On the sell side of the curve, however, now that there's been a change in the state of delivery, which I again teach as a closure below, in this case, it'd be this candle right here. Right? That'd be a change in the state of delivery or a market structure shift right here. Now we'll notice a similar pattern of resistance being offered by these down close candles. Right? This becomes a mitigation block. This too becomes a mitigation block. And you'll notice how sensitive price is to these areas because the algorithm is referring back to these levels as now institutional resistance. Once offered support, now offer resistance. So you'll notice that is a key theme, right? As we move lower until we deliver the other side of the curve. And then So we have a breakaway gap up here, and we traded into it, meaning this RDB has delivered the sell side, right? And now we're looking for the buy side. Now the buy side has been traded into. The last thing I'll do is I'll show you how I use this knowledge of a breakaway gap. That's probably the most important thing, right? A breakaway gap can be used as a measuring tool. We can take a projection from the origin, right? The genesis of the move is what ICT teaches, and we can project that to the low or the high of the breakaway gap. In this case, it's the high because it's a bearish one. And we can use levels then to see where likely reversal points are. As you notice, the 2 to 2.5 is a very, very key pivot, which I teach, which you can expect some meaningful level of reversal. Again, let's look at the bodies here, because the bodies are going to be telling us a story more so really than anything. As you can see, we hold that 2.5 very aggressively, and we are pairing it right with the idea and context of this narrative and reversal. Okay, so now this week we trade into our breakaway gap, so I'm going to rename that to a sell side imbalance, buy side inefficiency, because it's been traded into now. And also you notice this is in what's considered a deep premium. Optimal trade entry is what ICT teaches as the 70.5% retracement. So we've now repriced ERL to IRL, right? ERL to IRL, and discount to premium. So we're expecting we're anticipating, right, based on the higher time frame charts, which I did in my last lesson. I'm not going to go through it again. I mean, notably, you have a weekly fair value gap here, which you can see, and the same concept applies on this chart as it does on this chart. We're expecting lower prices. So a TGIF expectation can look like this. We want to look at the week, and we want to see if we can find a 20 to 30% retracement of the range, which looks like, wait, let me find the weekly candle. Wrong way I'm drawing it, my bad. Okay. Yeah, I often draw it the wrong way because I'm thinking about the expansion and the retract. Yeah, so when I first drew it, this would make the most sense to me. However, right, because this is a bearish retracement, we're actually looking at this range right in here. So this is the high that's being retraced. So essentially, we're looking at the sell-off, right, from this high and this low, and it's referring to this point here. I drew it the wrong way too, as well, though. It is not entirely obvious, isn't it, PMA? Totally. So yeah, I'm not entirely sure. I'm gonna be transparent. I'm not entirely sure if this is a permissible way of taking a TGIF range. I would usually assume that in a bearish week like this, you would, yeah. So I think the rule is, and don't quote me. I will backtest this and I will confirm it with you guys. You want to look at the direction of the candle, whether it's an up close candle or a down close candle, and then take a fib from either the low to the high or the high to the low, depending on the direction of that candle, meaning the implied close of the weekly candle. Does that make sense, PMA? Mhm. Oh, totally. Yeah. Yeah. So the reason why I had it on my chart like this is because I've used this rule of if it's an up close candle on the week, if I'm anticipating an up close candle on the week, right? This is why you have to be anticipating a TGIF movement, not I mean, you're never going to be shown a TGIF movement. It's always going to be anticipating a pullback from a high or a low. So in this case, you can see each week we come very, very close to meeting this anticipation level, right? Here would be, we draw it, and this week we draw it from this high to this low, right? And we're anticipating that we close somewhere back in this range. So the reason why I drew it like this is simply because I was expecting a down close candle on the weekly, and because I'm drawing my TGIF fib on the weekly chart, I'll go from the high, which is the implied, right, high of the week. We don't know it's going to be the high at this point in time, but it's an implied high. And I'm going to take it to the low. And I'm going to say from this high to this low, I'm expecting somewhere in the range of 20 to 30% for there to be a closure. You know why this is confusing, PMA? It's because usually on a bearish week, the low is put in early, the low of the week. Usually on a bearish week PMA, the high of the week is put in early in the week and not later in the week. Does that make sense? That's why you drew the Fibonacci the wrong way. But the real way in which you have to think about this and the mechanism for this movement is actually derived in the retracement of the weekly candle. So the reason why me and PMA both at first thought we should draw it like this is because, usually a candle has an opening, a low, high close, right? Especially opening, low, high close for a bearish week, which looks just like this, but we expect that low to be put in early in the week as opposed to late in the week. So we would want to draw it upwards like this. However, because the low is put in actually early in the week and the high is put in late in the week, which is not a classic sell week weekly profile. What that is called is a seek and destroy Friday expansion. Go to core content, I think month 3 ICT or month 6. This is a seek and destroy Friday expansion profile. And that leads to a Friday high of the week in a bearish profile, which is extremely rare. And you'll usually only see a Friday high of the week in a bearish weekly profile with what? What do you guys think? What would lead to that kind of event? Mm-hmm. It's high impact news. Yeah. So when you have a Friday driver, that's a red folder, high impact news, that's when you might get the profile. I posted somewhere in here, I think. I don't know exactly where it is, but I think I posted it. Um, let me check. I can try and show you guys a schematic. Yeah, here we go. So this is a bearish Friday seek and destroy profile, which actually sees Thursday or Friday being the high of the week. Again, look for high impact news drivers. I'm going to do an entire probably series of lessons on market profiling guides. I don't know if I'm going to do it as in depth as I do with my students in here, but with my students, I'm going to make sure we hammer this home because this is such an important kind of set of concepts to learn. But I'll definitely do a couple of lectures in here about that. And that's what my anticipation for the day was, at least, was a seek and destroy Friday high of the week kind of deal. So instead of drawing it upwards, we're actually going to draw it downwards, which is kind of messes with your head a bit, but it makes sense if you think about it in context. And that's our expectation for the day. Okay, so now that we have an expectation for the daily reach, we want to see a run into this here, which is buy stops, buy side liquidity. And then we want to see a nominal, or in this case, a significant retracement back into our weekly draw, which is going to be a bearish target, this Friday 20 to 30% draw, and also now targeting these lows for next week, right? Because we've now moved from ERL and IRL to ERL and IRL, and now we're going to move from ERL and IRL to IRL and ERL down here. As you notice, if you look at the higher time frame charts, you're going to see a very, very clear narrative as to why price is rejecting so hard. We had a shallow raid of this weekly inefficiency. And if you guys came to my last lecture, this is the weekly fair value gap on quartile theory, I teach that anytime we see an inefficiency that's only traded that's not traded into a discount, that's not traded into a discount or premium of that inefficiency, that's a prime entry for turtle soups. And like you'll see, what happens up here, right? This isn't traded in. This is not traded into over here. It's inducement, and it's turtle souped. And then up here, we have a shallow raid of this inefficiency. Again, using quartile theory, you can show that, prove it to yourself. We do not raid or rebalance a premium of this gap. Notice how we only rebalance 75 or the lower quartile. Then it's a turtle soup candidate. Likewise, up here, as you can see, it's the same story, right? We do not rebalance a premium level of this inefficiency, which is this one right here, right? So then we soup it again. Right? On this day, we only come in a tiny little bit We come in like 3 to 5 ticks, I think, or maybe no, 8 points, and then it's a turtle soup candidate. Again, on my last lecture, I talk about this a lot. You'll see down here, same deal, right? We don't balance a premium. We only balance the 0.5. Turtle soup candidates. Another example right here. Sorry, I'll do one more and then I'll move on. I'm kind of beating this dry. Okay, like, right, very, very shallow raid of this level. 1 tick in here, and then turtle souped. So we're anticipating some sort of likewise movement here, and we've generated a very, very nice failure swing. So if you came to my market maker lecture, you'll notice that this signature in here, which is what I call an LR signature, low resistance liquidity run, often involves some measure of failure swings, which we have 1, 2, 3, 4, right? Nice failure swings on the daily to kind of support a thesis that moves us lower. But let's get back into today's price action. So now that I have my daily levels marked out, why don't I transpose these onto my hourly chart? And I'll just stick on this chart for you guys like this. Okay, so on my hourly chart, I'm just going to stay on one chart today, and we'll do all the top-down analysis all from here. As you can see, we now look at today's price action, and the first thing I always ask, I always teach my students, is to look at London, because London is going to be the barometer or the comparison tool for the whole day. And London is really going to tell us something that can give us insights if New York is going to continue on trend or reverse on trend. And that was my last lecture actually on protraction, right? So if you guys can note the midnight opening price here, which is going to be this level right here. This is the midnight opening price or the true day open, whatever you want to call it, doesn't matter. Let's look at the 15-minute here just to paint this in some broader strokes, or some more specific strokes, I mean. So as you can see, there is a level of accumulation, like some small amount of accumulation that happens above this level, right? Let me make this bigger. In this range right here. Now, would you guys say that this is significant accumulation above the midnight opening price? Or is this really accumulation above and below the midnight opening price if we look at the dealing range high and low on this 15-minute chart? Is this one directional accumulation above the midnight opening price? Yes or no? It is above, but is it one directional? Or are we coming back down below and kind of, do you see how we're accumulating above and below the midnight opening price in this area, Duncan? Like, if we can consider this to be a, yes, you're right. But I'm asking, is this a one directional accumulation? Let's look at dealing range. Is this a one directional accumulation in a premium, or are we still accumulating in these wicks are actual candles? There's actual bodies in here, right? In the lower time frames. Are we accumulating strictly above the midnight opening price? Is the question I'm asking. No. We also have high impact news on Friday. So do we think, and also, I mean, okay, so this is a lot of explanation as to why New York actually took out London high. We had, again, I'm going to beat this to a pulp. What is this here? Is this a shallow or a deep raid of this level, of this fair value gap in here? Very shallow. But notably, there's also something else that you would tip your hat to what New York's going to do. And that's why this morning I called exactly where the reversal would happen, because it was pretty obvious to me at this point what was going to happen. We put in a very steep SMT with ES yesterday in London session. So look at this. Do you guys see how last night, and let's go to the hourly. Do you guys see how last night during the London session, ES retraces a premium of this gap, but NQ doesn't? Do you see how we have an SMT up here and down here? Do you guys see that right here? So ES actually repriced a premium level of the gap and NQ didn't, which immediately in my head, I'm thinking like sirens, because I wouldn't want to see NQ rapidly expand towards the downside without repricing somewhere in premium. I know ES could, but ES has been traditionally in the past couple of weeks, right, lagging. So I anticipate ES to be weaker than NQ, generally speaking, because tech's just been so strong historically. Like, look how strong tech is. I mean, look at the chart. Tech has been stronger, right? The bullish moves in tech have been a lot greater. I mean, look at this hourly chart, right? ES came all the way down to this area here, and NQ is still chilling, especially when you look down here, right? The bullish rises in this price action and NQ are a lot more. So I'd consider NQ to be at least cyclically right now stronger. So I would want to see NQ, if we're going to really sell off, rebalance a premium level. And that's just because I operate under the kind of motto that we need to have a significant raid and a rebalance before I want to get into a trade. Raid, rebalance equals good trade. So this SMT in my mind is giving me kind of sirens. What else about this chart makes it so very obvious at about 8 a.m. when we wake up? Let's say we wake up right at 8 a.m. How do we know price is going to, yeah, and also equal highs, and what else? What else is equal on this chart? At 8 a.m., we wake up right here and we just look left. What do we see? Look at this. This is beautiful. So what do I say I love to look for when I'm looking for a sell-off? What Yeah, exactly. It was tipping its hat to us, right? Look at this. Is this not LR? That's the biggest form of low resistance because in everyone's mind who's a retail trader and a supply and demand trader, this is considered a demand zone. Strong reaction with a break of structure to the upside on the hourly time frame, right? But we're not supply and demand traders. We know that this reaction wasn't actually because of this wick low. It was actually because we were trading in to this breaker block, which hadn't been rebalanced. So all we were doing was rebalancing this breaker block or order block. Do you guys see that? This is an unmitigated area of price right in here. So all price is doing for a neophyte or someone who's untrained in the eye, this looks like double bottom support, huge reaction. For us, we're like, no, this is mitigation so we can move lower after, right? This is all mitigated now. This entire area of price, at least this high, which is the most important part of this mitigation zone here, has been mitigated now. We've traded into it, and we've taken this order block, breaker block combination and pushed up higher. Now, when we sell off, we expect this to offer no support. In fact, what do we expect this to offer when we sell off, guys? Support or resistance? Yeah, and look at how it offers resistance as a mitigation. Yeah, breaker mitigation. Yeah, we can call it whatever you want. Breakaway or breaker block, right? We expect to see this now. This was beautiful delivery today, back into this breaker, right? I had this marked out on my chart. I had this down close candle, and here's my price target, my final price target, as you guys can see. I wanted to see us trade back into here. But beautiful, beautiful delivery here on this breaker block because we repriced it earlier, used it for its purpose, which was to drive price up to this high, and now it's just going to be straight butter all the way through. No support at all. And we expected that, right? And seeing the signature, you would expect that. So now let's get into how we trade this. So we have a good idea of narrative in our mind. We know that price is reaching lower. We have an anticipation to come into this 20 to 30% range. We have the equal lows down here. Essentially, now you guys are seeing my chart, right? So now it looks like this. Again, I'm going to copy and paste this level over. This is considered our retail support because we have a double bottom here and we have a fair value gap. So we have ERL above IRL, or yeah, ERL. So we have double bottom, right? Which is liquidity above a fair value gap. Oh, that's a great target. ERL above IRL is considered a strong magnet on the sell side of the curve. And as you can see, we absolutely tank towards it. And we go there so aggressively after taking out this high. So how do we trade this? Let's get into kind of the mechanics of, first of all, how we look at the chart here and identify a market maker model. As you can see, this is an original consolidation. I'm not going to repeat a lot of the lesson that I do every time here, which is explaining market maker models. I'm going to trust that you can go back and watch those if you haven't. So this is our original consolidation. Now we have a area of accumulation, which I'm going to denote as A1. Okay, and then we have a secondary area of accumulation, which I'm going to denote as A2. As you'll notice, something really, really cool that you can notice here. Um, Actually, maybe I'll ask you guys, what usually happens, right, before we move higher out of these accumulation zones? Yeah, perfect. So we have classic power of three in specific kill zones. That's perfect. That's exactly the answer I was looking for, right? We're manipulating because we have accumulation, then we have a kill zone, and we trade below the accumulation, taking out the weak longs in the form of sell side liquidity. This is where order pairing happens. Order pairing is what I've taught you guys is offset accumulation. So below these lows, there is willing parties who are going to be selling to close, meaning that the counterparty, which we refer to as the collectivist smart money, is going to be willing to buy. Because if someone is selling to close, there has to be someone buying to open. There has to be an order pairing in the market. If there doesn't exist that equilibrium, you can call it, or that order pairing, then your stop loss won't get filled. But more importantly, their longs cannot get filled on a whim. It's impossible. If smart money wants to drive price higher, they require a level of offset distribution or accumulation in this case. They need you, the market, to be willing to sell. So whenever you think price wants to move higher, in your mind, think, where are people willing to sell? Well, they're willing to sell with stop losses, right? My sell to close, sell stops. Perfect. These sell stops are being rapidly order paired or offsetly accumulated, which I've taught you guys. This offset accumulation here is seen by this exaggerated wick. These orders are destined for this high. Smart money is only trading the dealing range. They're not taking partials in between here. So they're offset accumulating, offset distributing. Then offset accumulating, offset distributing. Once you can start to see the patterns, right? And once you can really start to see how these specific patterns align with other things you've learned before, like Wyckoff, right? This is, for example, if you've ever studied Wyckoff or wave theory, right? This is called the spring in Wyckoff theory. So this is the retest, and this is the spring, and then this is also the spring down here. I don't care what you call it. You have to notice that manipulation, accumulation, and then distribution are all power of three phenomena that will occur before any move higher or any move lower. And then, right, accumulation one, accumulation two, final distribution. Up here, we have order pairing on the higher time frame chart, which is what? Our daily chart. And they're not distributing the daily chart order pairing, right? So when they soak these buy stops, as again, you'll notice, we put in many, many failure swings in here. This is what's called a three drives pattern. I can show it to you on a 15-minute chart maybe, or a 5-minute chart. You'll see. We have, in this area here, we have one. Let me use a highlighter. We have 1, 2, 3. That's a three drives pattern into a liquidity pool. Very, very strong signature of smart money reversal. And then, let me get rid of those dots actually, because on the higher time frame here, it looks like trash. Then the daily chart is reaching into its level. Once the daily chart reaches into its objective, we have, again, offset accumulation, order pairing, and they want to distribute all the way down here. Here is the only point of liquidity for them to distribute these sells to, because here you have a buy to close order, they are selling to open, and now they're only going to consider distribution into discounts. Discount to premium, premium to discount. Here's a dealing range. Below, above 0.5 is not where they're going to drop a single share. Every share will come off below here, and they will come off progressively more and more and more and more until they reach here. And guess what they're going to do down here? Offset accumulate these sell stops and drive price up higher. And the market will continue to book in market maker models. And once you see it, you'll realize that it's signature, right? It's a repeatable, understandable study. You can study it, and there's a mechanism. And if you're like me, you love to see things that have logic embedded in them. Like, not just, oh, we're reaching into here, why? Or we're reaching below here, why? If you can answer this, if there's a mechanism like, oh, smart money is manipulating to buy, or they're manipulating to sell, or they're accumulating. it really just makes the model really so much more cohesive because there's logic embedded, not just like price is moving higher because price is moving higher. Never that. That's never going to happen. So again, let's now consider our smart money reversal, which I'm not going to teach you here. You guys already know. It's validated by this market structure shift, right? Once we get this hourly market structure shift to the downside, as I've taught in all my lessons, and I probably beat this horse completely dead by this point, this first hourly structure shift is going to tip its hat to us and say we are now in a sell program. So what I'll often do on my chart is I'll come up here and I'll mark out this area, which is some people refer to as a rejection block, or you can refer to as a smart money reversal, or you can refer to it as whatever. I'll just say this is SPA, sell program activation. So now I'm looking for lower prices. Once I have SPA or SMR or rejection block or whatever the fuck you want to call it, I'm going to look for now these lows, because on the hourly, you can clearly see, right? I don't have to draw this out, but I will. Two sides of a curve, right? We have the buy side of the curve and the sell side of the curve. Very, very clear. Just as down here, we had a perfect, actually, it was almost equal in magnitude on each side, which was really nice to see. Down here, we had the exact same phenomena, right? And these things aren't random. We had a, okay guys, I'm sorry, I don't know what I'm doing wrong here. There we had a sell side of the curve, and we had a buy side of the curve. And you'll notice here, we have a buy side of the curve and a sell side of the curve. And in this little piece of price action right in here, we have a buy side of the curve, right? I'll show you, I'll draw a box around it instead of this thing. We have a buy side of the curve and a sell side of the curve right in here. And then another one right in here on a lower time frame. And then another one right in here. And another one right in here. Another one right here. Right? It's everywhere you look because the market is booking liquidity this way. I don't have to tell you guys, we have another one right here. Right? Sell side of the curve, buy side of the curve, sell side of the curve, buy side of the curve. And it keeps on repeating. Buy side of the curve, sell side of the curve, right? Here's the original consolidation here, and here's the raid. Here's the original consolidation here, here's the raid. So these things are just going to keep happening forever. The market will keep doing this. If it stops doing this, I'll stop trading because I'll lose my edge, which will never happen, guys. We're not changing how the markets book ever. So once we get this market structure shift, which is now going to be our sell program activation, I am looking for two things in my session. So to trade today, I'm looking, because I'm going to watch how London reacts. London puts in a bit of a protraction, but I don't like how we don't balance a premium. I don't like it. For me, this is not the sell-off I wanted to see. In fact, if you guys saw the channel last night, I trade pretty much every London session. I got stopped out on longs. I was playing this last night, and I got stopped out right here at minus 7 points or so, at minus 10 points, because I wanted to see a protraction higher and then sell-off and then continuation in New York. So I wanted to see something that looks like this. Trade up higher, then break down, then New York comes back into the optimal trade entry, and then break down. This is what I teach as a classic sell day. But in fact, we didn't do this. We had what's known as a classic Judas day. And a Judas swing is simply when London highs are taken out by a New York 9:30 a.m. movement before moving lower. A Judas swing occurs for two reasons, and I've taught you guys these reasons. Either there is a higher time frame PD array above the London high, or London trades lower into that higher time frame PD array. So either we reach our daily buy side or sell side target, or we have yet to manipulate into our daily sell side reversal target. There is only two reasons for a Judas to occur. I'll say that again. A Judas will only happen if London trades into a higher time frame sell side of target, whether it's liquidity or a PD array, or if London does not trade into a premium or discount PD array before selling off. Other than that, you will see what I like to call a classic continuation, which looks like this every single time. London trades up higher, then breaks down, then New York comes back into OTE. It'll come into specifically this range. This OTE range, right? And then it'll sell off. And if you don't believe me, just backtest literally every single day. Look at London. London does not take out this low, right? Therefore, there is a low-hanging fruit, right, point of liquidity. All evening in London, we accumulate on a bullish day above the midnight opening price. This is why I teach you guys protraction. Seeing this above the midnight opening price, we know exactly what's going to happen. London's going to push up above. Then we need to rebalance a discount. Perfect. Let's build up all this low resistance liquidity and then send it higher. This is a classic Judas day. Classic buy-side delivery Judas day. And you can see it in the signature. Look at the LR. Boom. Classic. In the same way that you will see it in this signature. Look at the LR. Boom. Right? Now let's look at a classic continuation day. London accumulates below the midnight open. Look, this is these 2 hourly candles close entirely below, and then 2 a.m. pushes up, right? Then we come back down in late London, forming the low of the day, and then New York continues. So this looks like a late London, right, protraction. Remember, I guys taught you guys this last lecture. There's 2 types of protraction, either early London or late London. Both ways, New York is going to come back in, like it does, into some level of discount, and then move higher, right? This is maybe OTE. This is this fair value gap, whatever. All you have to do is play this retracement and then a move higher the next day, or just play the straight up expansion. Up to you. Now let's look at another day where we have a classic buy day. This is not, again, you can see, not a classic buy day. This is not a classic buy or sell day, right? This is more manipulation because London reaches in. Actually, this is a great example, a great example of what I just said. When do we expect a reversal? London trades in to this higher time frame PD array. Remember, liquidity is a PD array. So remember I taught you guys, why do we expect New York to reverse? London reaches the buy side target. So then New York pushes up, right? Where is a classic buy day? Here we go, a classic buy day. Here is my favorite day to trade. But again, I've taught you 3 profiles now, right? Study these 3 profiles. This is one. This is called a New York reversal profile because we trade into the higher time frame PD array. So this is NY Rev pattern. This is NY Judas pattern. And this here is a classic buy day. Now, this is the sauce that no one is teaching you properly, and I can't for the life of me tell you why these Twitter Furus and ICT don't teach this better. This is what you need to know, right? When are we going to reverse? When are we going to Judas? And when are we going to buy? If you know these 3 patterns, you know the market. Yeah, because if everyone knew this, and everyone would make a lot of money. Yeah. So let me throw this in the chat for you guys, so you guys can refer to it. Okay. So these are our 3 patterns, and yeah, this is why if you come to these lectures, right, live, you'll get to see these insights. I guarantee you some people are not going to watch this part of the video, and that's fine. They're not going to get this information. And this is literally how I trade, guys. I don't teach you anything. I don't trade myself. Everything I teach you, I trade myself. So look at the classic buy day, for example, right? Exactly what I just talked about. What we're going to do is New York, right, is going to be an expansion, continuing trend of London, because London protracts. Where's the midnight opening price? London protracts below the midnight opening price into what? Into our higher time frame PD array, which is this liquidity, this fair value gap. Then there's no reason to come back to this low, right? It's accumulated in a daily discount below midnight opening price. This is an algorithmically determined level of discount. Then it's broken structure. Now New York will come back into OTE and continue the move. This down close move, right, from New York into New York. So let me take the measuring gap and show you, or the deviation and show you. So this is a swing low. I didn't even see that on my chart. This is a swing low, and then this is a swing high. This moved back into OTE at 10 a.m., right? The silver bullet back into OTE is not just OTE, which is 705, which you guys can see right here. I'll mark it out with fibs instead so it's easier. It's also returning to this PD array, which I teach you guys is my entry model, right? Return to discount or a PD array or liquidity sweep. This is all three. And then we push up. The reason why we move down is because we need to induce liquidity in the market. In a classic buy day, the market cannot just do this. It can't just go up. It can't. There is a necessity to facilitate the opposing liquidity in the market, or facilitate is a bad word. There's a necessity to induce. If there is no willing sellers of the market, then smart money cannot be the active buyer. So at this level here, when price is moving up, there are fewer sellers because this is bullish price action and momentum. This is a breakout for most traders. When we put in this hourly candle right here on the lower time frame, that is a bearish candle on the 15, on the 5, on the 1, on the 30 minute, on the hourly. This is a rejection candle. Look at that. We sweep the high and we move lower. This induces short party liquidity. So smart money can be the opposing offset accumulation party. Where are they going to accumulate these cells? So when they're allowing people to sell, they're buying, they're buying, they're buying, they're buying, they're buying, they're buying. This is why this down close candle is an order block, guys. Think about narrative here. In this candle, smart money is actively buying the market. They are allowing people to get their sell orders filled, right? Sell to open, sell to open, sell to open, sell to open, right? That means smart money is buying to open, buying to open, buying to open, buying to open. They drive price all the way down to not a random spot, but a specific location. Here is a fair value gap on the hourly. This is inducement. I teach you guys this for a reason. Think of returns to fair value gaps in bullish market conditions, right, after our smart money reversal down here, as inducement. Every low that is rated, every swing low. So for example, we have a swing low right down here. Every low that's rated is a chance to be a buyer because you want to recognize order flow. Order flow in this candle is bullish. It doesn't look like it. You don't see it at face value, but this candle is exceptionally bullish for the market. This shows a willingness for the market to move higher because we're rebalancing this PD array, inducing shorts, and then I'm going to ask you one question. What rests above this high now? What does buy stops mean, PMA? No, but you're right. It's buy stops. What does buy stops mean? Does it mean it means buy to yeah, it means buy to close though, right? So tell me based on the concept of offset accumulation and distribution, if someone is if someone is buying to close and someone is retail, let's say, what has to happen there if someone is buying to close? What's the other side? Someone sell to open, right? So here, sell smart money was selling, right, in a premium, correct? They sold, 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 sold. Then here, people here want to buy to close, meaning they're going to be pushing the market up higher for smart money, while smart money accumulated their longs in a discount. So think about it. Here's where it gets crazy. I try and teach people this, but it's maybe I don't teach it well. Smart money doesn't want to buy up here. What they want to do is they want to buy down here and drive price higher. So think about the reaction that happens at this high. You have people who are short the market now getting double fucked because now not only are they getting stopped out, they're actively pushing price higher for smart money. Right? Do you guys understand that? Because here their buy stops mean they have to buy the market at this point right here Tell me, PMA, how much that sucks if you were short the market. Not only do you get stopped out, but smart money accomplishes their entire goal. It's so evil. It's genius. It's exactly how IPTA books. Think about what it's doing. IPTA is accumulating alongs in this down close candle when everyone is shorting the market, meaning they're getting their buys at a huge discount. Then they're pushing price up and forcing you to buy the market at this high. You don't think about it. You're like, no, I'm getting stopped out. That's not the same thing. It is. You getting a buy stop is the exact same thing as you buying the market. How evil is that, PMA? How genius is that? How smart is that? Yep. Yep. Because it's so easy to want to sell the market in this candle. When I see that candle, I am so bullish because I look at this in 8 a.m. and I'm like, this is a classic buy day. I don't want to buy this high. I don't want to buy this high. I'm waiting for this. And that's why I teach you guys rules. And my students know this. We can never enter a trade without two rules. And that is a return to a discount PD array or a liquidity purge. If you don't get a raid or you don't get a return to an inefficiency, you don't get a trade. And the reason is because you are not. What's up? Yeah, right here, right? And this low. So twice they're stopping out sell stops as well. But we don't trade unless we get those two conditions because we aren't going to be liquidity. No, we're not buying this candle. Never. I'm never buying this candle. We're buying down here. We're buying with the algorithm. And then here, we're letting all the fools who got stopped out actively buy the market for us because they're buy to close. That sucks for them. They're getting buy stopped out, meaning they have to buy the market at this huge premium or huge premium. Then look what smart money does. In this candle is where they got all their fills in this candle. They return price back down here. What do you think this piece of price action, these two candles, does? There's one word, and I've said it 5 times in the past 10 minutes. What is this piece of price action? What is it? One word. Yes, it's inducement because, again, there's a swing high put in here. This is now going to be what sort of stops the rest above here, PMA? Buy stops, right? So smart money will drive price down. They are buying the market, buying the market, buying in down close candles, buying, not selling. You're seeing down close candles because they're offering price. They're offering it lower. For smart money to offer price lower, they have to buy. I'm going to say it again. For smart money to offer price lower, they have to be the buyers because others are going to be selling. So when someone is selling the market, smart money needs to be buying or else those orders don't get filled. So you see down close candles, but those are bullish candles of accumulation if you have narrative. If you have narrative. If you don't, then you have no idea why this is happening. So again, same exact thing, right? Down close candles during what time? Lunch. Lunch is going to retrace. In those down close candles, smart money will accumulate their position for the final move of the day, which is going to be a run on liquidity. This is the inducement. IDM, LRL, all these words I always say. Boom, into what? This order block, price moves higher, then everyone up here gets absolutely screwed because they have to buy to stop out, meaning they get to accomplish smart money's goal, which is this level right here. This swing high right here by one single tick. They get it. Boom. Daily goal complete. Open, high, low. Wait, open, low, high, close. Classic buy day. Look at this as one candle, right? Open, low, high to the daily objective, close. Then look what happens the next day. Low resistance liquidity, a shallow raid, only one tick. What do you think is going to happen? You guys already know. Don't look at this day. What do you think is going to happen to these relatively equal highs before we reverse? Of course, we're not going to leave it. We're not. It's not going to happen. It's too easy to take those guys out. Now we have a New York Judas pattern to the next day. Days flow from one to another. This is narrative, okay? Look at the next day. Look at where we accumulate again for this move up in London. London gives us a classic protraction. Midnight opening price, we're below the midnight opening price. We trade in to this set of down close candles. I'm just going to copy this, take you here, repaint this order block, this one right here. Oh, what a coincidence. Now we're in the order block that we've repriced to, we've induced. What the hell does this look like? Sorry if I'm repeating this. This is so important. What kind of signature is this, guys? All of these failure swings. What kind of liquidity run is this going to be, guys? Low or high resistance? LR, boom, it's absolutely smashed. Then, because London, right, accomplished its goal of protraction and then expansion, New York reached the target, which is previous day high. New York reversal pattern. Judas, pre-New York, pre-news drop. Then, do we expect news to Judas swing? PMA. Based on you seeing this, do we expect the news drop at 8:30 a.m. to Judas swing? Yes or no? No, it doesn't need to, guys. I just answered your question. Is news going to Judas swing? There you go. There's your answer. Is news going to Judas swing? You now know everything you need to know. Look at this chart. Take a picture of this chart. You know everything you need to know. When are we going to classic buy day? When are we going to Judas? When will news Judas? I enter before news drops all the time because news has no reason to return above this high. We've already accomplished that. We've already smart money reversed. Yeah, I entered it at like 8:10. Right when the kill zone opened, I entered. No, it's not. It's not ballsy, and people will tell me it's hindsight, and I'm not. Guys, I'm teaching you how I trade. I'm not teaching you anything else. I would gladly enter on a 5 minute confirmation anywhere in this candle before news drops, because this is narrative. Look, this whole piece of price action is narrative. Buy side of the curve, sell side of the curve, smart money reversal, order pairing, offset accumulation, right here, bang, there, right there, that wick, offset accumulation, bang. We're not going higher than that. Sell off into what? Discount P array. What? Okay, I'm repeating myself, but this is cool. What level of this gap was not balanced, guys? Was a discount of this 1 hour gap balanced with this candle? No, so it's a turtle soup target. Boom, there it is, another example. Turtle soup, and then we push up higher. Right? You trade this move down, and you expect this low to be ran. Not because it's just a swing low, but because it has a shallow balance of this inefficiency. This is the buy side of the curve, and this is the sell side of the curve. This specific section of price right in here is a market maker model that we trade. Oh, that's not anything you can see. That's the same color. That's too dark. This is a buy side of the curve and a sell side of the curve. Boom. Every time frame it happens, it repeats. It's a signature. And then we get, a push back up into the end of the day. Why? We have open, high, low, close. The next day, daily objective. Maybe it's this order block down here to go higher, right? Here we're accumulating. This is low probability, NFP, whatever probability. But you still have the exact same logic. Midnight opening price right here. London accumulates above. New York reverses, takes out these lows, taps into this piece of price action. Wow, look at that. I just extend the order block, and would you have it? Look at the bodies. Not a coincidence, right? This was once a break of structure, change in the state of delivery, meaning we are bullish, we're not playing shorts. So this move down I played, but I wouldn't advise that you play because we have buy expectation. But if you understand the market to this extent, you can play both. Again, we come back into the bullish breaker block and boom, classic New York reversal pattern because London trades into the higher time frame of interest, PDRA. So why does New York not continue lower? Because London accumulates above, then distributes, then order pairs, rebalances this breaker, and then moves higher because we have buy expectation. Where do we have buy expectation to? All the way up here. So all of this move down is just what? What are these moves down, PMA? Yep, and manipulation, correct? Manip, expansion, generating. What is this? All of this now becomes what? You already know what I'm going to say. What is all of this? All of this high, this high, this high, this high, this high, this high, this high. What are these? Lower high resistance. Low, 1 day, absolutely expanded through all of it in one single fucking hour almost. 2 hours, done. 3 days worth of price action, 3 hours. Because narrative. Because we know it's going to happen. New York reversal pattern all the way up. Come back down, trade back into this up close candle, which is a breaker block. Right? Breaker block. Look at the bodies. Higher. Finally, today, sorry I got so off track, but it's really good stuff. It's really this is probably one of my best lessons. I say this every time. This is stuff that they don't teach well. It's not taught well. And if it was taught well, there'd be a lot of better traders. And it took me months and months and months of studying to actually get these concepts myself. And I wish someone told it to me just like this. I wish someone just did this for me. Okay, now we come into today. We're expecting lower prices. Yeah, crazy manipulation in here, right? No, but that's why we always look left. We don't look right ever. I never look to the right of the chart. I mean, there's nothing to look to the right. You always look left, and especially you always look to the previous session. You notice how I'm looking left on the day, but I'm also looking left in London. Bad traders look to the right. And when I say that, think about what I mean. Bad traders see this up close candle and look at this up close candle and say, what's the next one going to do based on this one? No, we want to look far to the left. What does this up close candle mean in relation to these candles? Don't look now, look back. Don't look forward, look back. Never anticipate, predict. And that's not what most people will tell you. And that's very, very contrary to the majority of trading advice, which is you can never predict the market. I would say you should always predict the market. You should never just react because a reaction here is bearish or bullish PMA and these down close candles on the hourly. Is a reaction here bearish or bullish? Bearish as hell, right? Is a reaction here bearish or bullish? Bearish. What did I say about this down close candle? I look at this, I look left, I'm like, these are incredibly bullish candles. I cannot wait for us to trade back into this. And I entered here. And by the way, you can fact check me. Every one of my entries is almost posted live in the channel somewhere. I'm not just saying this. I actually buy these down close candles. I buy them. I buy the accumulation. I buy this manipulation leg. I look for a time and a price and I align that and I buy. And then we expand. And then we expand the next day. And then we expand the next day. And then we expand the next day. And then we reach our price target. And now we're looking for sells. And we're looking for this area of price, which is TGIF. Boom. Huge reaction yesterday. Did I get a PMA? Did I get a trade yesterday? Yes or no? Yeah, no. And how many people FOMO'd into that for no reason? Like you even asked me, and Renault's even asked me. He said, like, I feel terrible. I missed the move. What did I tell you? What did I tell you guys? There was nothing to trade. That's not the move. This is what we want to see. If we didn't see this candle, I wouldn't be happy trading today. I just sat out, guys. I traded. You know what I traded? I traded this. I got my 60 handles right in here. 56 handles or something like that. I traded this move into buy side, which was the high resistance liquidity run, but I traded alongside my bias, which was bullish until this high is taken, and I wasn't going to play shorts. You bet your ass I wasn't going to until we took this high. So I got my small move of the day. I don't care. Yesterday wasn't the day I got my big move. Today I got 300 points because I just waited. And yesterday I didn't take anything. I saw this and I told the guys who I teach, I'm like, we're off the charts. Nothing to look at. Just chill. Don't do anything. Just sit. And some people did and some people couldn't, and that's fine. I get it. It's hard to look at this because PMA, if you're reacting, is this bearish or bullish? And you want to chase this, but look what happens. You will come back up and we get given a chance. So none of this is playable. Think about how many people would have chopped themselves up in here. Not us. I did actually in London. I expected London to do this, and I was wrong. And I have no problem being wrong because I took a 7 point loss. I wanted London to come up and then for us to come down and then do this, but we didn't. So I took a 7 point loss. Whatever, 7 points. Yeah, but today in New York in the morning, I put in our chat at 9:26 a.m. we're going to stop dead in our tracks at this low right here. I just gotta search random in my name and it usually comes up. But I want to see what time I posted it actually. Oh, that's wrong channel. I just want to see what time it was at because I don't know what time actually I thought it was at. But I remember waking up pretty much immediately and being like, "We're gonna stop dead in our tracks right here." Sorry guys, just be patient with me for 1 second. I see winks. Okay, we're getting close. All right, there we go. Right. So we waited for this level right here, and I said we're gonna stop dead in our tracks right here. Right. Look where we'll stop. Gun to my head. Right. I didn't expand it to the right, so fuck. I don't get the. You could have said it's hindsight, but look, we're gonna stop at the breaker. That's the anticipation, right? We know that's gonna happen because we're rating this low resistance liquidity, right? So now we have our 2 rules. I'm going to stop fucking beating around the bush and just tell you the entry model. 2 rules. Stop hunt. Return to a premium PD array. Breaker plus FVG. What is this? What is a breaker plus FVG called? Boom. Unicorn. Super high confluence setup when paired with narrative. Go down to the 5-minute, right? Midnight opening price. Get rid of that. I can get rid of that now. Trade into it 1 tick. And then what did I tell you, PMA? Instead of what I wanted to do, right? Because if I wasn't in Discord and I didn't have to be accountable to people like you guys and actually myself because of that, I would have shorted this tick high. But what did I say, PMA? This morning when we traded into here, what did I say to wait for? So although you want to chase, and although I wanted to buy every fiber of me wanted to just slam my shorts right here because I've been waiting for this, right, all day. I didn't. I followed the rules because the rules are going to help you in the long run. So even though I missed out on 20 points, 30 points, who gives a fuck? I followed the rules and I teach you guys the same way I trade. So I didn't enter here. I didn't enter here. I didn't enter here. I didn't enter until I saw this market structure shift right here or this one right here, whatever you want to take. It doesn't matter which one you want to take. They're both valid, right? This is a swing low and this is a swing low. I used this one right here. Now we have our full market maker model I teach you guys. Go back to the last lesson. Nothing changes. Liquidity purge, stop hunt, structure shift from the 5-minute, return to a fair value gap or an order block. I used this order block, right? You could have also taken this structure shift down here, right? And then used this order block. So you had 2 choices. There's this, or there's this. And on a 5-minute, this was the first one though, right? Right, there's this one here. If you want, you can take this wick here is a valid shift, and this is a valid shift. So let's just use the first one. Yep, and this is a valid order block. This is an implied fair value gap as well. In these wicks, we have premium and discount levels of the wick. So you can look and do quartile theory like I teach you guys and see if we rebalance above, 75, try and maybe tap into 50. We don't get it. Doesn't matter. We have narrative. This is aggressively moving away because there's news, right? And then I also said, oh, you might have used this mark structure down here, PME. I think I did too, actually. This one here, right? Okay, it's also valid. Yeah, I think I did too. I just didn't see that. Yeah, I didn't see that. Sorry, I completely lied, guys. I shorted this here. Yep. Yeah. I was wrong. So sometimes I get yeah I get. You gotta know something about me in my head. I often have like 3 days worth of price action in my head going, so I forget which day I took which trade. Especially when I'm teaching, I'm terrible at that. So sorry. I entered here. We just broke structure here, and I entered on this return. Now this is narrative, guys. These bodies are respecting this order block, right? In fact, this is what Dave teaches as a double top continuation on a lower time frame. You'll see it. So here is the move, the up close candle that broke structure on the 1 minute. I don't use this concept very much because I don't like my students going on the 1 minute, so I don't teach this concept, but you can look at this. So this is the up close candle that broke structure, and you can see, whoops, I drew it the wrong way. It should be up from the bottom to the top. You can see we're double topping that 70 area. Yeah, a liquidity sweep is permissible. Double top, sell off. This is what Dave teaches. FX is a model. I definitely have it somewhere here. I 100% have that model, and I say study it somewhere. Let me see. It was 3 drives, but not higher highs. It was actually lower highs. Not necessarily, not the way ICT teaches 3 drives, but it's still a topping pattern. So if you guys want to look into it, this is Dave teaches FX concept. My students don't use it, and you don't need it. You don't need it. This is actually completely not necessary. But if you want for more confirmation, sure, look for some sort of topping pattern. I just don't. Just trade market maker models, guys. Just trade market maker models. This is a valid order block. This candle is permissible. That's fine. This is news. This is manipulation. That's fine. It can close outside. You're looking to see if the invalidation point for an order block is actually a closure above the swing high that puts it in, right? So a closure above this swing high is the invalidation at a strict level. So this is your quote unquote invalidation. Again, I'm going to put this in quotation marks because you have narrative, right? I don't care if this comes all the way back up and soups this high. I don't care. I'm going to enter again. I have no problem, guys, with holding this, like, from me personally. I have no problem holding this from here all the way to here, taking another contract here, and then taking another contract here, and then my DCA puts me somewhere here, and I'm down 30 points. If I lose, I'm going to lose 150, 200 bucks. I'm okay with that. I have narrative supporting me. I know we're not closing, first of all, above this inefficiency, like this 1 hour for value gap. I also am almost positive at this point we're not closing above this breaker block. So I would be willing to risk a candle body closure above the breaker block. It's fine. You have narrative, right? This is where entry models are not important. And people hear me say that and they're like, you're crazy. And I'm not. Entry models are the least important thing. Everything we talked about, everything we just did here, this is important. This is whatever. This is the last step, the easiest step. Just take your entry model based on the rules I give you guys and you're set. Okay, so you're shorting. Again, yeah, you can add. I added. I didn't alert this, but I added here at this order block. Right here. I added in this down close candle. I also added one more time, actually, in this breaker right here. If I got it. I know I added one more time. I think we just tapped into it. No, it wasn't there. Maybe I didn't. I remember it might have been this one here. I added twice because I scaled out. What I do is I take partials and I scale back in because I like to secure profits and then play more of the move. Sometimes that's not smart, and I've been burned by that by doing it wrong, but I've gotten better at that recently. So for example, I took an entry here and then I took a partial, maybe below this low, like on this down close candle, and I swear to God I got another entry somewhere. And maybe I didn't. Maybe I didn't today. Maybe I'm thinking of a different day. Because then we went eventually to my TP, which was right here. Oh, there's a million ways to get in. You can get in on a million entry models. I can show you every one here, okay? Order block here. Boom. That's your first entry. There's actually at least 10. Okay, order block here, right? Or breaker block, whatever you want to call it. Breaker block, order block, another entry right there. Close below this wick. This is now a breaker block, entry there. Or this order block here. So that's 5 entries already. Okay, we move down, we move down. We break structure right here, right? We close below this candle low. Look at the bodies. Close below, retest, breaker block, get in. Then we come down. We close through this. A closure below this with displacement, get in. Come back up here. And we don't get, we see how we put a double bottom in on this on liquidity right here. Do you guys see this double bottom right here? Okay, look where we trade back into. Obviously, the 5-minute fair value gap. Here's your last. Did we get into it or no? Oh, we don't. Okay, so I would have said you can take one more entry here and then ride it down. Okay, so then last thing I'm going to show you guys is how do I get price targets? Because you guys often see I'll have like nice deviations, and I look for a couple things. On a day like today, I'm going to use a Judas Swing because we had one, and it's obvious with narrative that the Judas Swing is manipulation. So I'm going to use this high to this low, and I'm going to project that into the future. And that's how I got the low of the day, almost. Let me see. I think I missed it. I think I overshot my projection by 1 tick. Yep. So 15062.5 is the algorithmically coded terminus, meaning a fourth deviation. Fourth deviation is considered by IPTA to be an extreme displacement, meaning you'll get some form of retracement, usually between 2 and 2.5. So what I like to do sometimes is put my background on, get rid of the prices, and just keep the levels. And I'll look for some sort of reversal between here, right? Then I'll look for 3 to get tagged. I'll look for another reversal, and then I'll look for 4 to get tagged. If the draw on liquidity is lower, then I'll look for continuation after reaccumulation in these areas. But I won't ever hold past my fourth deviation, ever. If you know me, I'm always, no matter what, if we're past the liquidity and we're past the third or fourth deviation, I'm out. And here, like we literally got the bottom of the day. We missed it. We overshot it by 1 tick. So there you go. 15062.5 is where you take your final partial, and that's the low of the day, coincidentally. And then we're also in this daily fair value gap, which for me, I don't really care about at this point in time because I know it's not going to offer a great amount of support, right? Based on our narrative, I know, look, for me, I didn't have that on my chart even. I didn't care about that fair value gap. Yeah, totally. Oh, totally. Like this is, guys, we're not done selling off. Yeah. Look, we closed, look at the narrative here. We closed back within this hourly inefficiency as expected, right? This is a fair value gap high. Yeah, I expected us to close back within this fair value gap. So now what are we going to do on Monday, Tuesday of next week? What's the weekly profile I taught you guys? The one I taught you. Tuesday high of the week, right? Monday push up, Tuesday high of the week. What does this all become? What does this have? What happens when we do this? Boom, 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 boom. LR signature. I'm going to be so happy to trade, not these moves up. And my students won't trade these moves up. I might. You're like anyone who works with me is not going to because we're bearish. We're bearish. So if we see a Monday expansion, if we see a Tuesday expansion, we don't trade it. There's no reason to because you can just trade alongside your bias and be patient. And then look what's coming next. Let's look at my higher time frame targets. Well, this is a very clear manipulation, right? Yeah, look at 14,932, right? Also, yeah, look, this deviation matched up. This hourly projection from this sell program activation matched up right there as well. So yeah, we got some great levels here. As you can see, we came into that third area between 2.5 and 3 and reversed. We came into TGIF, right? Everything here. Look at how the bodies react to this area here. Now go back test every single week and look at how the bodies react to this area. This is a piece of homework for my students. Look at how this price action is booked by IPTA. It balances this region, and then we can accumulate here. It doesn't matter. Once this objective is met, 415,166, yeah, it doesn't matter. Everything else here is just cookies. This shit in here, no one's interested in trading. If you're trading this like PM session, for anyone who traded PM session, you're stupid. In my books, sorry, that might be rude. In my opinion, there's nothing to trade. Did anyone here try and trade this? This is impossible to trade. Okay, well, he is he's a better man than me. I can't. I could not. Like literally, I'm being honest with you guys. I could never do that here, right? Like for me, there is nothing in here. This is just impossible to trade. And let's be real. This is not what you want to trade. Like everyone can see if you just look left that you don't want to trade this, you want to trade this. So yeah, PM. Okay. It's a nice trade, yeah. It's okay. It's okay. Yeah, no, but it's fun. Like you got a good like here is a good plan, right? Taking out ERL, retrace some IRL. It's probably an hourly fair value gap or maybe a 15-minute fair value gap. Yeah, it's a 15-minute inefficiency, right? This is a redistributed, rebalanced PD array. Look at the bodies, right? Sell side, buy side, sell side. I taught you guys in this last lecture, so you guys probably know what that is. Yeah, it's a great trade. I wouldn't trade it, but it's not a bad trade at all. I think though anything past here, yeah, yeah, here is tough. Like if you're trying to trade like the PM silver bullet, like sure. I mean, yeah, you can take this trade, fine. This is a very, very obvious, like this is a market maker model, like on a 1 minute, sure, right here, 5 minute inefficiency, trade into it, go down to the 1 minute, very, very clear market maker model, right? Do you guys see this? Original consolidation, A1, A2, distribution, smart money reversal, A1, A2, distribution. So sure, maybe you can trade something like this. Why though? Like why? Like it's just the day is over. Enjoy your in my books. In my books, like sure you can take this. Yeah, honestly, it's a valid market maker model. So the way I teach, I should tell you guys this is completely valid. And if you want to trade it, go for it. But the better trade is what you already got in the morning, and be content with enough. In my books, right? Like you got this. You got your 300. Like what did I get? What did we get? First entry here. Yeah, we got our 200 points. Just be happy, right? This here is not needed. You can just enjoy the rest of the day without having to trade. But yeah, this is a valid market maker model at the end of the day. As you can see, it's all fractal, right? So a 5 minute PD array produces a 1 minute market maker model. Very clear market maker model in here. And what do you see here? Do you guys see this market maker model? This is the one you traded, right, Liftbox? Yeah, very clear market maker model. Original consolidation, accumulation, right here. Reaccumulation, distribution, reversal. Not really an accumulation, maybe this. Yeah, lunchtime reversal. Yeah. So yeah, you'll notice the market maker models are booked on every time frame. I can go to a yearly chart. I can go to any time frame chart here. A 12-month, 3 month, 6 month, 100 range, 15 second, 1 second. There'll be a market maker model because this is how price books. This is how it's coded to book. Um, yeah, we deliver to our price target, get the low of the day, and that's that. That was today's price action. It was a very, very clean day, at least the way I perceived it, and it was a very obvious move from this area here. And now next week, right? What's the anticipation? I mean, do you guys all? Yeah, I recorded this. Everyone should have this. I'll take a picture of it again, so we can all refer back to this. Okay, let me just clear all this out so we can look at what's happening on the chart. Actually, look at this one. Okay, so now looking at our hourly chart, this is one with all my lipstick on it. We have traded through this mitigation block. This hourly BISI supported price as expected. The original consolidation here has been taken out. Now I'm expecting a two-phase distribution, meaning I'm expecting to see another small market maker model up. Maybe on a 5 minute time frame, we're going to see come into here, right? It's going to look like a market maker model right in here. Then a sell-off, second phase distribution of the higher time frame market maker model, which is the daily market maker model, right? We're going to have sell-off, accumulation Monday, Tuesday, sell-off, accumulation next week, sell-off. All of this stuff is fractal, all of it. It's all the same shit. And then I'm targeting 14,949. That's the original consolidation, right? Here, below. So this market maker model, if you zoom out, this is the original consolidation. This is an accumulation. But for this market maker, this is the original consolidation. That's why it's all fractal. It doesn't matter. You can see clear consolidation areas and mark them out because those are either going to be accumulations in a higher time frame market maker or original consolidations in a lower time frame market maker model. That's how the market works, right? Consolidation is either going to be the origin of a move or the accumulation of an existing move. And to think about that logically, it just makes sense, right? This is the origin of this move, but this is the accumulation in this move. And this is the origin of this move, but it's the accumulation in this move. And then this, if you go back further and further, right? Look to the left. Let's go on the daily chart to the left. You're going to see there is going to be an original consolidation right here, right? This is going to be a market maker model. This was a market maker model. Buy side, sell side, right? Sell side, buy side. Sell side, buy side. And then buy side, sell side. Same thing time and time again, and it's all a part of this market maker model. Sell side, buy side, which was all a part of this market maker model in here. Let me zoom out even further. Okay, now you can just look. Sell side, buy side, right? It's all the same, all of it on all time frames. If you understand that, you understand the hardest part of it is that you have to be able to understand where market is trending by looking left. So 19949, this area in here, which is an unmitigated premium order block. This here is an OTE. This is also a time-based PD array, right? This happened in the London session or the New York session before expansion higher. This time-based order block is going to be on my radar to trade into, then consolidate, move higher, and then come down into here. We will 100% hit this, at least on NQ. Unless ES and NQ have a crazy divergence again, like they did last week, this should be hit. Okay, that's today's lesson. Any